People should take an index fund for what it is. They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
In this rare interview in the 1990s, Jack Bogle, the funder of Vanguard, one of the largest asset managers that revolutionized investing with their ETFs, shares his views on the topic. Exchangeable traded funds, ETFs, are game changers, allowing the retail investor to own a diversified basket of stocks tracking an index like the S&P 500, avoiding the high fees charged by many funds.
This is a large cap oriented fund. There will be a time when small cap and mid cap funds will do better than large cap stocks, but it's not here now. And to my delight, it wasn't here in the decline. The index fund gave a wonderful account of itself when the market went down mid-July to the end of August. Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market, and 4%, only 4% at the peak. They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course. I don't think there's such a thing as a stock picker's market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one. Fees in the mutual fund industry, I'm sorry to say, are generally pretty outrageous. And you add to an average fee of 1.5%, at least another 0.5% for the fund transaction costs inside the portfolio, which isn't disclosed separately. And then mutual funds are tremendously, except for index funds really, tremendously tax inefficient. And the index fund is going to pick up another 1.5 on tax efficiency. I think sooner or later fund investors will see the light. You see more attention paid to cost in the press. You see more dissatisfaction with the mutual fund as an investment medium in the magazines, on television. And I think the industry's got to adjust to a different era. The fees are too high, and that's all there is to that. Well, you need, first, I think there are far too many funds in the industry. I mean, I don't know what one does with 9,000 funds. Now, of course, I can immediately jump to our own defense, which maybe is a little bit unfair, but you need a number of index funds because investors are getting more specialized, and some investors want the 500. My preferred index fund happens to be the total stock market, which includes large, medium, and small stocks. But some investors with a blue chip portfolio want an aggressive entry into, say, small cap growth funds. Well, a small cap growth index fund is a very intelligent way to do that. So, to a point, we ought to meet public demand. We shouldn't be creating, we as a company or we as an industry, mutual funds whose only reason for being is to appeal to a marketing need that is unsound. They were bearish when they should have been bullish, and bullish when they should have been bearish.
Subscribe to our channel for more ideas from Wall Street. Information is power. The Owl of Wall Street.